Hey guys, I hope you and your families are doing well. In this video, I'm going to teach you the most important part of trading that nobody teaches you. But before we do that, let's just take a look at the emotional roller coaster that a trader goes through. And do any of these emotions feel similar at certain times during a trade? So here, you buy the breakout, you're feeling a little bit coy, right? You're feeling, yeah, I'm pretty good at this trade and stuff. The trade starts getting out and you think, I'm pretty good at this trade in malarkey. Look at the profits that I've got. And then the share price starts to pull back and you think, oh no, all my profits are going, all my profits are going. I had a winning trade, now it's going to be a loser. What do I do? What do I do? The confusion that kicks in. And then down here, where suddenly all of your profits have gone and what was a winning trade is now looking like a losing trade in your account. You're like, what on earth has just happened? And then it starts rallying back and you get a little bit excited. You go, I'll get back to break even. I'll sell at break even. But it never gets back to break even, does it? And then it starts to roll back over here. And this is where you go, I cannot even believe what is happening on this trade. And when it starts getting down here, you don't even want to look at the screen. Like you just turn around and you just ignore it. And this is where you could then hold losses in your portfolio for weeks, months, and years. We've all been there. We've all done it. So what this video is going to center around is eliminating these final four emotions, okay? These final four images that you see giving back profits, the hope of it'll get back to break even, then when it starts rolling back over and you can't even bear to look at the stock, look at what's happening in your account. So these final four with these red arrows, this is what this video is going to center around. Removing these type of emotions because of these trading decisions from your trading. That's what we're going to be focusing on in this video. So the most important part of trading, no one teaches you, and it's going to have a heavy emphasis on risk mitigation. So for me, there are four areas of a trade. There are four systems to really be working on when trading. Number one, identify a high quality setup. Number two, initially control the risk, create asymmetric risk versus reward trading opportunities. Number three, mitigate the risk. That's what I'm going to be teaching you in this video. I'm going to show you a lot of trades from my own trading account as well. And then number four is selling guidelines, selling rules to help you optimize the profits. Before we get into it, MarketSmith are today's video sponsor. You can see various MarketSmith charts of some of the stocks that I'm going to be taking you through during this presentation. If you're interested in a discounted trial, there is a link in the comment section below. So with all of that out of the way, let's start here. So this is the ideal type of trade, right? The home run trade, but it's not always possible. It's going to be down to the stocks, it's going to be down to the market, it's going to be down to how you handle it as well, and do your systems enable you to handle trades like this. So for me here, this is the entry at $278. Free roll it by selling 1/3 of the position the day after the entry, and then up here starts getting extended. So I choke off 1/3 of the position. I've still got 1/3 left, and then when it breaks decisively the 50 and takes out the low, that's where I exit the position. Over $140 gain on the final third that I was selling relative to the entry at 278. So 278 to 420. These are the type of home run trades. But guess what? They don't come around every single time. So I'm showing you this one here, which is kind of like perfection. This is a really, really good trade and really well managed. But guess what? This is not trading from a textbook. Real life, it's not always that clean. It's not always that simple. So this one here, this is DraftKings. You can see the brokerage statement up here. So you can see the prices of the entry, the free roll, and the exit as well. And then you can see here, left, 0. So that means there's no shares left. So those of you have interactive brokers, you will understand what this looks like in your statements. So here, this is the entry in the free roll, and I'm going to be teaching you about free rolling and take you through different scenarios as well. So here is the entry and the free roll, and then I hold it during this basing period, starts to get out. I decide to hold into the earnings. So I think it's a real leading stock at this time. Very volatile on the earnings. I place my stop loss here, but guess what? It gaps down underneath my stop loss that was just below $30. So then I don't get stopped out where I intended to get stopped out. Guess what? That's trading. That's real trading. So I'm going to be taking you through some of the ugly trades, not the trades that are just always really pretty and the ones you see in textbooks, because trading ain't like trading from a textbook. It's not. This is RCL. This is Royal Caribbean, okay? I buy it here. I free roll the position that I'm going to be teaching you about. Then heading into the earnings, I don't have a very big profit cushion. So I understand the implied volatility move on the stock heading into the earnings. So I sell a quarter of my position here, hold it into the earnings, and then try and hold it through this basing period, takes out the 21-day EMA. So I exit the position here. I place my stop loss underneath the low of this bar. I exit here. So it doesn't look like Nvidia, does it? And guess what? Not every trade's going to look like Nvidia. Here's one, Nvidia. This is a better one, okay? Entry here, free roll it here, and then the stock starts to get out. These are better ones. Does it happen every single time? It doesn't happen every single time. So we have to learn. Remember that first schematic that I showed you where it gets out and then it pulls back? That's what we're going to be talking about, and I'm going to show you some detailed scenarios as well. So we're going to come back to this a little bit later, and I'll really take you through the maths. So when we are looking at the setups that you're going to see, so you're going to see a lot lot of setups. I can show you now briefly. You're going to see a lot of setups. So stocks that I was actually trading, okay, stocks I was actually trading, and I'll show you the brokerage statement as well for how I manage the position, and I will explain the thought process. And then at the end of the video, I will take you through a bar by bar example on TradingView to show you how I plan out the trade. So when you are looking at the setups that I'm going to show you shortly in the trades that I took, most are going to be within variations or around variations of these common chart patterns. Flags, triangles, pennants, cup of handles, wedges, flat base, also known as a Davis box. There are key candlesticks in terms of entry candlesticks I'm looking for, and candlesticks I like to see in the base. I like to see variations of shakeout demand tails. Taught you all about these in the blueprint video that's on the channel. Variations of gap down reversal bars as well. So I like looking for these. Variations of trigger bars, which are commonly, they are low volume tight inside bars. So these are the type of setups that I like to look for, and you are going to see as we progress. Are those candlesticks new? No, they're not new. They're absolutely timeless. Here is a weekly chart of the Dow Jones. Shakeout demand tail, gap down reverse bar, more gap down reverse bar, more shakeout demand tails, more trigger bars. It's absolutely timeless. It is literally just supply and demand visually showing itself. So let's go through a couple of them, okay? This one here, this is REPL. So this is where the entry plus the free roll is. So you can see up here on the brokerage statement, okay? You can see the entry level, you can see the free roll level, and you can see the exit is now. Now what I've done for all of these is just kept it in a standard example for 3,000 shares. So I can just take you through the math. We'll keep it 3,000 for each of those because the math is nice and easy to explain to you. So you can start to understand the importance of free rolling. So let me run you through this, okay? It's building kind of a VCP flag, whatever you want to call it, ascending triangle. You basically have one contraction bounce off the 10, two contractions bounces off the 21-day EMA with a gap down reverse bar, then a shakeout demand tail, and then you get this shakeout demand tail doji type candlestick off the 21, and then you basically get back-to-back inside days pretty much. Look how the volume dries up, nice and tight. This is what I like to look for. So I have the entry plus I sell 1/3 of the position to free roll. I push my stop loss up as well, and then I get knocked out here on the remaining 2/3 of the position. So what would have been a full loss is not a full loss. I'm out the other side actually with a net profit on this trade. Let me run you through the maths, okay? So these are example 3,000 share positions, as you're going to see for all of these. So we just keep it standard, and I can emphasize the importance of risk mitigation. So the initial risk on the trade is $1,980. Why? Because we have a 66-cent stop loss and our share size is 3,000. So here you see this minus 66. So that is 66 cents, which then equates to 2.38% risk on the trade. Okay. So our risk on the trade with this example 3,000 share position is $1,980. Okay. Now what do we do? Well, our profit on 1/3, which is going to be 1,000 shares of the 3,000, is 860. Why? Well, because we have an 86-cent gain when we were selling those 1,000 shares. So if you take the exit, the partial exit here to free roll the position, which is this one here, okay, 28.64 minus the entry price of 27.78. So 28.64 minus the entry price of 27.78 equals 86 cents per share profit on 1/3 of the position. So that's $860, okay? But then we have a loss on 2,000 shares. Now our loss on the 2,000 shares is a 40 cents loss. Now how do we get to that? Well, we take our entry minus where we got knocked out. So what we're doing is we're minusing the entry here, or we're minusing the exit off of the entry. So 27.78 minus 27.38 is 40 cents. So we have a 40-cent loss on 2,000 shares. So 40 cents times by the 2,000 shares, $800. So we take the 860 minus the 800, actually net profit on the trade is $60. This is the art of risk mitigation, okay? So rather than coming out the other side with a $1,980 loss on the position, like most traders who traded this would have, and most are probably bag holding it down here somewhere as well, actually we're out the other side better than break even on the trade. Make sense? This is what we're working on, okay? I'll teach you this in detail. I think it's so important. As I said, this is the most important part of trading that no one teaches you. I'm going to teach you, okay? So this one here, this is ORIC example. So from the 18th of January, all these examples are from this year. So this one here, flag type pattern, right? Powerful move up here. Look at the volume coming in, starts building, get a shakeout demand tail off the 10, again bounce off the 10, off the 10, off the 10, and then you get this tight little inside bar coming through here. The volume dries up. Now you'll see that I put my entry price, so 6.04 is where I got filled on the position here. I didn't get filled right at the high, so again I'm taking you through what actually happened here, okay? So I have the entry plus free roll. So my entry is here at $6.04, then I free roll by selling 1/3 of the position at $6.49, and then I push the stop loss up as well. So I'm going to be teaching you this about how you can start adjusting initial stop loss, pushing it up, because the point of risk mitigation, okay, the point of risk mitigation is not to maximize the upside. We do that in the optimizing profits. It's to minimize downside whilst leaving upside potential. So the point and the purpose of risk mitigation is not to maximize the upside, it's to minimize the downside whilst leaving upside potential. I want to get the risk out of the trade. So if you take a look here, okay, our initial risk on this trade, assuming a 3,000 share position, as I said, just kept it standard 3,000. So hopefully to teach it to you, it really just makes sense and the math is nice and easy. So the initial risk is $840. Why? Because we have a 28-cent stop loss. So see this minus 28 in here, which is 4.64% risk off an ADR of over 9%. That's pretty good. It's around about half. Okay, that's good metric. Profit on 1/3 of the position is $450. Why? Because we have a 45-cent gain times by 1,000 shares in this instant here. Okay, because if you take the free roll level of $6.49 minus the entry of $6.04 is 45 cents, right? So selling 1,000 shares at a 45-cent gain is $450 profit. But then we have a loss on 2/3 of the position, 2,000 shares of 24 cents. Okay, because this is where I then got stopped out here at $5.80. Okay, so we have a 24-cent loss on that 2,000 shares. So our net is actually minus $30, effectively break even, right? So we do not get out the other side because you would have been knocked out here with a full stop. And guess what? It's been a pretty choppy, pretty hostile market. So this here is really, really important, I think, for keeping your accounts in order. Like, your defense is of paramount importance when trading. The old saying in football, okay, strikers will win you a game, defense will win you the league. Okay, strikers win you the game, defenders will win you the league. Defense is so important. Sun Tzu, Art of War principle of invincibility lies in the defense, the possibility of victory in attack. So this is all about risk mitigation. Okay, invincibility lies in the defense, the possibility of victory in attack. That is what risk mitigation is designed to do. Still leave you with the potential to attack, but make sure your defense is impeccable. Okay, really, really important. So we then come out the other side, we don't have a loss of $840, we have a loss of $30. Effectively break even on the trade. Okay, so let me take you through a couple of scenarios and then we will start working through some more examples like this. Okay, so when you are trading, when the trade actually starts getting out, different scenarios open up to you. Now, you may be aware of this, you may not be aware of this. If this is your first time seeing it, you're about to be made aware of it. So let's run through 3 different scenarios. So the principles of risk mitigation, as I said earlier, the purpose of risk mitigation is not to maximize the upside. That's not what we're trying to do in this part of the trade. Remember, there's 4 parts of a trade: identify, control, mitigate, and optimize. What we are trying to do is minimize downside. Minimize drawdowns, minimize downside, position ourselves beyond the possibility of defeat, another Sun Tzu Art of War quote, whilst leaving upside potential. So if we work through these 3 different scenarios, okay, we've got 3 different traders, imagine. So one is scenario 1, one is scenario 2, and one is scenario 3. And at the end, decide which trader do you want to be. Okay, so scenario number 1, okay, we have a trader here. Each of them is buying at exactly the same price and exactly the same amount of shares, and they have exactly the same initial risk because of their stop loss placement. So each trader is buying 3,000 shares here at the breakout level of $100, and all of them in these 3 scenarios are going to put their stop loss at $97. So about 3% stop loss. So they have initial risk on the trade of $9,000. Why? Because each share has $3 risk associated with it, because you're buying it at 100, you're putting your stop loss at $97. 100 minus 97 in my maths is 3 times by your 3,000 shares. That gets you to your initial risk. Hypothetically, you can have gap downs, you can have slippages, of course, but $9,000. Now, what scenario number 1 is going to do, so trader number 1 in scenario number 1, they are going to sell into the first pop. So breakouts will usually have successful ones, a pop, a test, and then a reversal. They're going to aggressively sell into the pop. So what they do is they go, right, well, what I'm going to do is I'm just going to sell my position at 2 times my initial stop loss. So I'm looking for a move of 6% or $6. So therefore, I'm going to sell when price hits 106, I'm going to sell my position. Okay, great. So they sell their position at 2 times their initial risk. So they now have just locked in $18,000 profit. Nice trade, right? Because you have $6 times by our 3,000 shares. Remember, 106 minus 100 is 6 times by the 3,000 shares. That's how we get to $18,000, 6 times 3,000. So net profit on the trade, 18 grand, right? Not bad, good trade, right? Especially if this is in maybe a week or something like that. Let's work through scenario number 2. So this is free roll. This is risk mitigation, okay? So scenario number 2, trader number 2 goes, okay, great. I have my entry, I have my initial risk. Now, how they manage the trade here is differently. They go, right, price has now hit 106. That's 2 times my initial stop loss. So what I could do is I could sell 1/3 of my position because I'm up 2 times where my stop loss is. That could be initial stop loss. It could be new stop loss, as I'm going to show you in the bar by bar example a little bit later on. So they go, right, I'm going to sell 1,000 shares, 1/3 of my 3,000 share position at a gain of $6, which is 2 times my initial risk, which is $3 a share. So I'm going to lock in $6,000 profit. profit. Now, what has that done? Well, they still have 2/3 of their position. They still have 2,000 shares, right, that they bought at $100. Their stop loss on those 2,000 shares remains at $97. So they have open risk on those shares, because just because price is at 106, it doesn't mean that it can't come down to $97, right? Stocks can go up, stocks can go down as well. So their open risk on the 2/3, 2,000 shares, is $6,000. Why? Because they have $3 risk associated with those shares, times by the 2,000 shares, 2/3 of their position they still have left, $6,000, right? So what have we done? The current worst case scenario is they are break even, because they have their $6,000 profit minus a potential $6,000 loss if it goes from 106 down to 97. Now, as the asterisk implies here, worst case can be worse with gap downs and slippages. I'm aware of that. This is a hypothetical example that I'm running you through so you hopefully understand the concepts I'm trying to teach you. So they have an open profit on 2/3 of the position of $12,000. Why? Because they've got 2,000 shares sitting with a $6 profit up here at 106 at the minute. Their open profit on the trade is $12,000, but their current total profit, because remember they sold 1,000 shares of their position at $6,000 profit, so their current total profit on the trade is $18,000. So the difference between scenario 1 and scenario number 2 here is, well, scenario number 2, at this moment in time, the current total profit is $18,000, which was the net profit from scenario number 1, but they still have 2/3 of their position. They still have 2,000 shares with a gain on it. Now, why can this stock not go to 112, 120, 130, 150? Why can it not double and go to $200? Why can't it? So what we're trying to do here with risk mitigation, the purpose of risk mitigation is not to maximize the upside. We're not trying to do that in the risk mitigation part. It's to minimize the downside. So remember, the current worst case, they're now break even. Prop to 106, sell part of the position. Our worst case scenario, hypothetically, is now a break even on the trade, but it's now open-ended. Why can this stock not go to 120, 125, 150, 175, 200? Why can it not? Why can it not go to $300 and up 200%? Why can it not? Find yourself in the right market environment with the right stock. Why can it not? So this is the better scenario, I think, for me, that I'm trying to position myself in the vast majority of cases. Scenario number 3, entire position, but has open risk. So scenario number 3, same entry, 3,000 shares at $100 in here, same initial stop loss, 97, so that's $9,000 open risk on the trade, initial risk. The open profit, because we're up here at 106, the open profit is $18,000. Haven't sold any shares in scenario number 3, okay? The open profit is $18,000. Why? Because we have a $6 profit on 3,000 shares. That gets us to $18,000. But our open risk remains $9,000. Because there's no reason why, as there was no reason why this stock can't go in scenario number 2 and scenario number 3 as well. There's no reason why the stock can't go to 120, 125, 140. But there's also no reason why the stock can't come back down to $97 and much lower, $80, $70, $50. There's no reason why it can't do that. So the open risk in scenario number 3 remains $9,000. Because the share price can go from 106 to 97. We haven't de-risked the position, we haven't free-rolled the position, so our worst case scenario is still $9,000. Is this starting to make sense? So when you break it down and you think about the scenarios, would you want to be scenario number 1? Do you want to be scenario number 2? Do you want to be scenario number 3? Which one do you want to be? For me, I want to be scenario number 2. And this is then how we build systems and routines into this, to help with this. So it's then putting it back to the systems and what are the inputs into the systems from an identification, a controlling, a risk mitigation, and an optimizing profit standpoint. Now, sure, in different market environments, do you want to potentially tweak the optimizing profits? Yeah, you may want to do that. You may want to sell more aggressively. In really good markets, you may want to sell less of your position, actually taking off a quarter at 3 times your stop loss or your initial stop loss, and have a bigger part of your position left to try and ride a bigger trend. So the systems level can change subject to what market environment you find yourself in. Now we're really going deep down the rabbit hole and we'll see Alice in Wonderland very shortly. So let's go through another couple of examples. But this here, this is what it's all about, okay? Realize as the trade starts to get out, the way you can manage it can be different. You can create different scenarios for yourself. Now this is the same whether you're a scalper, whether you're a day trader, whether you're a swing trader, that could be an active swing trader, a position swing trader, a long-term investor. It's the same, right? Risk mitigation is applicable to you across all time frames. How do you want to manage the position? How do you want to manage the trade? You have options. You have options. Understand your options. Understand your systems and your processes that then feed into those options. How do you want to manage your trades? especially in different market environments, especially in choppy and hostile market environments, I will be super quick on the risk mitigation side of it. I want to get the risk out of the trade. So this one here, this is AI, okay? Puts in this inside bar after a horrendous bar, and it was actually building kind of like a VCP low pivot, right? 1 contraction, 2 contraction, 3 contraction, tight little bar hit. There were loads of like momentum leaders, high quality stocks putting in inside bars on this day as well. So I was like, okay, let me go with some juicy ones. So ADR, decent liquidity in this stock. ADR is 8.25%, pretty much. It's going to be probably quite a quick moving stock. So what do I do on this one? Well, my entry is here. Through the high of this bar, I get a good fill on it at 39.99, and then I free roll by taking off 1/3 of the position, and then I get knocked out hit, stopped on the remaining 2/3. So rather than come out the other side of it with a full loss of 4.25%, I'm actually out the other side with a net profit on the trade. See what we're trying to do here with the risk mitigation? It's really, really important. And as I said, nobody teaches you this. I haven't seen another video on YouTube anywhere. You can't, nowhere in a book will anybody teach you this, but it's arguably one of the most important parts of trading. When you think about it from a system standpoint, when you think about it from an identification part, you've got to identify a high quality setup. That's of paramount importance. Number 2, you've got to control the risk. That's of paramount importance. Number 3, I think you've got to mitigate the risk. Certainly in choppy and hostile markets, it's of paramount importance. And how are you optimizing profits? That is also of extreme importance as well. Everything is important, but this is very important. I don't think anyone will teach you about it. Well, basically because they don't know how to do it either. So this one here, example, 3,000 share position. So the initial risk is $5,100. Why? Because we have a $1.70 stop loss on 3,000 shares. So here it is, minus $1.70, which is 4.25% risk if you think about stop loss percentages, okay? But we have a profit on the trade using this hypothetical 3,000 share example of selling at 78-cent gain on 1,000 shares, okay? So if you look here, this is the free roll level of 40.77, okay, minus $39.99 is 78 cents. So here, 1,000 shares times by 78 cents equals we're locking in $780 profit on 1/3 of the position. We still have 2/3 of our position now. Now we can move into the optimizing profits. But as I said, I'm showing you a lot of trades where they've just basically U-turned. Fake out breakouts, whatever you want to call them, pop and drops. But I'm showing you the less sexy side of trading. I'm showing you what actual trading on a day-to-day basis looks like. This happens a lot. Happens a lot, as you can see. I don't think anyone else will show you trades like this. This happens a lot. How do you protect yourself against it? Do you have the skill set? Do you have the systems in place? Can you execute on that? It's a question. Trading is a skill set. When you start treating your trading like a skill set and you start viewing yourself from a third-person perspective and going, okay, what is my skill set in terms of identifying setups? Am I any good at it? What is my skill set in controlling risk? Am I any good at it? What is my skill set in terms of risk mitigation? Am I any good at it? What's my skill set in terms of optimizing profits? Am I any good at it? What you tend to get is a lot of traders who think they're traders and can't trade. They have terrible skill sets and only just blame everyone else. They don't realize that they don't have the skill. Like, this is elite. What you are doing is you are competing against the sharpest minds, the brightest computers, really, really good traders out there, and everyone's trying to take your money. You don't realize how competitive trading is. And you don't realize that you don't have the skill set. Imagine going into the Colosseum a couple thousand years ago and you go up against an elite gladiator and you've never picked up a sword before. It's game over in 2 seconds. You don't have the skill set. So work on your skill set. Realize trading in specific areas, and you can break it down and you can deliberately practice in different areas, improve your identification, improve your controlling risk, improve your risk mitigation, improve your optimizing profits, improve your position sizing, improve your overall portfolio management for how much exposure you want. It's really key. Let's go on to the next one. That was a little bit of a rant, wasn't it? But it's important. So this one here, Z-scaler, okay? You get this shakeout demand tail, undercuts the base lows, volume's only 30 bar average. That tells me there ain't much supply there. Then you get this quasi inside bar, volume dries up. I'm expecting it to move aggressively through this level. It does. So entry plus free roll. Now, as I said, I've been really quick to be free rolling. Why? Because this is happening, right? If you see, again, it comes back to what type of market environment are you in? For your style of trading, are you in a healthy market environment? Are you in a choppy market environment? Are you in a hostile market environment? Now, I come to that conclusion each day for which type of market environment I think I'm in. Now, that's a discretionary view. There's different things that I look at, which I cover in weekday videos for members and stuff like that, for how I reach that conclusion. But if I think I'm in a choppy market environment or a hostile market environment, guess what? The risk mitigation, it doesn't slow down. It speeds up. Why? Because this is happening more often. This U-turn, okay? Pop and drop, fake out breakouts, whatever you want to call them. When I see this happening more often, guess what? I'm going to be much quicker in that third part of the trade, the risk mitigation. So what I do on this day here, okay, the entry is at 144.30. So the entry is through the high here. I free roll the trade by selling half, because it's a choppy hostile market environment at this time here, at 145.43. As the stock starts getting out, I adjust my stop loss from low of the trigger bar day to the low of the breakout day, because when this thing starts powering out here, it shouldn't U-turn below. I'm protecting myself against that. Good breakouts won't do that. They'll just rip through. So then what I do is I adjust my stop loss up, and then I get knocked out here at 143.16. So if we work through the example, the initial risk on the trade, assuming 3,000 share position size, is $8,670 profit. Why? Because you've got $2.89 risk per share. Here's the $2.89, okay, minus 3,000 shares. Okay, that's how we get to $8,670 risk with 3,000 share position size. The profit on half the trade is $1,695. Why? Because we're selling at $1.13 gain on 1,500 shares. We have a loss on half the trade. Okay, we get stopped out on the other half of 1,710. So we have a $1.14 loss on 1,500 shares. So we have a net loss on the trade of $15. So what we've been able to do is, rather than come out the other side here, okay, where our initial stop loss was at 141.41, rather than come out the other side with a loss of $8,670, we've come out the other side with a loss of $15. Remember those scenarios. Which scenario do you want to be? Which trade did you want to be? See how important this is? So creating systems and routines. So I'm just going to spend a slide here before we start going into a couple of other ones, because it's really important for you to start thinking from a systems and routine standpoint. There's a brilliant book called Atomic Habits by James Clear. It's top 3 books I have ever read, ever listened to on audiobook. I prefer audiobooks, okay? You do not rise to the level of your goals. You fall to the level of your systems. Realize that no matter if you are doing this as kind of a hobby on the side, or if you're trying to take this very, very seriously, or you're a professional trader, realize you have systems. Doesn't matter what level you are in terms of experience and skill, you have systems. You have systems in 4 areas. So for active and position swing traders, there's 4 parts to every trade. This is where the systems come in. So number 1, identify a high quality setup. If you don't have much experience and you don't have much skill, you probably don't know what a high quality setup is. Number 2, control the risk to create asymmetric risk to reward trading opportunities. Again, if you're new, you don't have much experience, you don't have much skill, you probably don't know how to do that. You may not even know what the word asymmetric means. These are things you need to learn. 3, mitigate risk to free roll the position. Many of you, even experienced traders, probably won't know how to do this. Probably never been taught it. Certainly with the math as well. 4, selling rules and guidelines to help optimize profits. What are you doing? Where are you selling? Why are you selling? What's your guidelines? How do you go about executing that? Do you have the discipline and the consistency to do that? Do you know what you're doing in each 4 of these system areas? If you don't, having any sort of consistent system and routine is going to be difficult for you. It's about building systems and implementing them into your routine. So what are your systems? What are your routine? What are your systems from an identify, control, mitigate, and optimize standpoint? And then how does that feed into your routine? If you think about market time, there's basically 3 types of market time. You have when the market is open, you have the post-market, and you have the pre-market. So what are you doing in the post-market to identify setups? Create your trading plan. What are you doing in the pre-market? What are you doing when the market is open? How are you executing your trading plan? So basically post-market and pre-market is creating the trading plan. Then when the market is open, that's executing the trading plan. So you're creating the plan, then you're trading the plan. Rinse and repeat on a daily basis. This is what you're trying to do for years and years and years, decades and decades and decades. Be consistent. So this one here, MOD, 28th of September. Okay, so this one here, back-to-back inside bars. Okay, leading stock, 1 contraction, gap down reverse bar underneath the 21-day EMA, pulls back down, shake out demand tail, gap down reverse bar, back-to-back inside days, RS line turning up, 52-week highs, leading stock, thermal management. So this one here, entry plus free roll by selling half of the position. Why am I selling half? It's a really choppy, hostile market environment. So I'm aware of these U-turns. I'm aware of these breakout fakeouts. I'm aware of stocks just popping and dropping. So guess what? I'm going to protect myself against that. I have the skill set to do that. I've been doing this a long time. So here's what I do. Here's the entry here, 45.45. The initial stop loss is down here at 44.27. So initial risk on the trade is $1.18, so 2.6%. But then I adjust the stop loss up to lower the breakout day. So then I get stopped out of the position. So example, 3,000 share position size, initial risk is $3,540. Why? Because we have a $1.18 risk times by the 3,000 shares. Profit on one half of the position is $1,275. Why? Because we've got an 85 cents gain times by 1,500 shares. Here you go. I'm literally showing it to you. Entry, free roll, exit, what's left? That's how I go about trading. You want to learn this? Go over to my website, join my platform. That's what I teach you. Loss on half of the position, 1,335. Why? Because we've got 89 cents. There was some slippage on the exit. Okay. times by 1,500 shares. So are you going to get slippage and things like that? Yeah. So we come out the other side with a net loss of $60. Do you want to be out the other side with a net loss of $60 or a loss of $3,540? What do you want to do? Here, Shockwave Medical. So this can happen as well. You ever been caught in these? Sucks, but it happens, okay? So Shockwave Medical, okay? This one here, there was a really big, funky shakeout demand tail. I got caught in it. So there's a big supply shoot coming through here. I actually think this was maybe like IBD stock of the day on this one as well. So it gets out, gets sold into with this supply shoot. Okay, I was able to free roll into that, but then I actually have a bigger loss than I intended because I got a lot of slippage here on the exit. This can happen, okay? And this is why I said earlier, the hypothetical worst case scenario. You can have gap downs, you can have slippages, and I'm going to show you on stocks that I was in. Okay, so here you go. So example, 3,000 share position size. The initial risk is $24,480. Why? Because we have $8.16 risk associated with it. So here's the $8.16. Still a pretty tight stop loss. Remember, this is a much higher price stock. It's $294 stock. So $8.16 is 2.77%. Relative to the 20-day ADR percentage of 4.25%, that's a pretty good risk metric. It's less than 2/3. So we have $24,480 risk associated on this trade. Our profit on 1/3 is 13 grand. Why? Because we're selling at a $13.09 gain on 1,000 shares, but we have a loss on 2/3 of the position of basically 17.5 grand. $8.76 times by 2,000. That's how we get to our $17,500. So we have a net loss on the trade of $4,430, but we got a lot of slippage from this funky shakeout demand tail. And that sucks, but it happens. As I said, I'm showing you what real trading looks like. It doesn't look like those perfect examples you see in the popular books. It doesn't look like this. This is what real trading looks like. This is what you have to contend with on a daily basis if you want to do this. But would you rather come out with a loss of $4,430 in this example, or a loss of $24,000? What would you rather do? Learn to protect yourself. Learn to protect your capital. Now, what I should have done in this instance here, to actually backstop in a profit, is at the end of this supply shoot here, as I was saying here, I should have moved the stop loss to break out LOD, low of day. So I should have moved the stop loss to break out LOD. So what I should have done is moved it up here to the low of this bar here, because this is a funky supply shoot, okay? A lot of selling took place on here. It went, got slammed back in. What I should have done is adjusted the stop loss up from 286 to what that would have been, $292, $293, where I'm pointing to with the pink arrow. That's where I should have moved my stop loss to. And then I wouldn't have had a loss of $4,430. In this example, it actually would have been a backstop profit. Makes sense? So here, I could have improved. And this is why doing the post-analysis on your own trades is important. I could have improved that. Big supply shoot on the day of the breakout day. It's probably going to pull back. Could be a little bit funky, could be a little bit whippy. The stock is a bit of a whippy stock. It's not the smoothest of movers. I should have been more aggressive here with the stop loss placement. Upwork. Here's one here. So I was targeting it through here, but then cancelled it because of the, I was targeting it through the high of this bar, shakeout demand tail, nearly an inside bar, but it kind of went without me. I didn't get filled any shares from memory on this day, and then it kind of popped and then pulled back in. So yeah, maybe it would have been a break-even trade, don't know. But this one over here, this then one I took and I got filled, okay? So entry plus I sold half of the position. Why? Pop and drop, pop and drop, pop and drop market. Tough market. So I'm going to speed up the risk mitigation, the third part of the trade. I'm going to speed up. I'm not going to slow down. I'm going to speed up. I've got to play the game quicker. In choppy and hostile markets, and certainly in hostile markets, the game either don't play the game or you've got to play the game quicker. Either don't play the game, and if you're a position swing trader, really think about whether you want to play the game in hostile market environments. But if you're an active swing trader and you're still playing the game, I think you've got to be quicker. So I will be quicker in the third part of the trade, the risk mitigation. So this one here, okay, example, 3,000 share position. The initial risk is $990. Why? Because we have 33 cents risk per share times by the 3,000 shares. So here you go. This is the entry here at 1504. Sorry, I should have moved this up a little bit, 1508. But this one here, for how we're planning the trade out, I was actually filled at 1508. I realized I just made a mistake there. Apologies about that. But we'll just work through this example here. So 33 cents, assuming you get perfect execution at 1504, and perfect execution is rare, right? You can see I got filled at 1508, not 1504. Okay. So in this instance here, 33 cents at risk. So profit on half of the position, $555. Why? Because we're selling at a 37-cent gain times by 1,500 shares, half of the position. Then the loss on the remaining half of the position, $780. Funky shakeout demand tail. You're gonna get some slippage. It happens. Okay, so you're assuming that, okay, yeah, I get out this one around about break even, but then you get a load of slippage, like you saw on Shockwave Medical, like you see in ORIC. So then we actually have a loss on those final 1,500 shares, not of 37 cents, of 52 cents. So then the loss is $780. So then the net loss on the trade is $225. But would you rather lose $225 or $990? What would you rather? And don't be the trader that then bag holds it all the way down here. Right? Remember what we did, that example at the beginning. Do you see it? Gets out. Oh yeah, I'm a genius, I'm a genius, I'm a genius. Oh, I'm giving away my profit. Oh no, oh no, oh no, oh no, oh no. Not good. We don't want to do that. Don't be that trader. AMR. So this is a coal-related stock, this one here. Okay, so you can see where the entry is, you can see where the free roll is, you can see where the exit is. So pop and drop. Now, again, would it have been better if I just kind of top ticked it and sold at $172? Absolutely, it would have been. But for me, I'm an intermediate term swing trader. So when the NASDAQ composite is above its monthly 10 EMA, I will try my best to hold for those intermediate term trends. I will try and hold for trends along the 10-day EMA, the 21-day EMA, potentially the 50-day simple period moving average. Maybe with commodity stocks, I'll be more minded to use the 50 on part of the position. Case by case basis, depends on the setup, depends on the stock, depends on the market environment. But what I'm doing in here, in this YouTube video, is I'm showing you a lot of trades that didn't work out. And a lot of trades that, the most frustrating trades, right, are pretty much this one here with AMR, okay? It gets out, you have a decent gain on the stock. It goes from like $159 up to nearly $176. Okay, that's a pretty good move, $16 move on it. And then I get knocked out here, break even. A little bit worse than break even because of some slippage as well. It's frustrating, but these trades happen. And emotionally, you've got to be able to deal with them as well. This is going to happen to you a lot. If you think every breakout, every trade that you take is just going to fly off and go up 100%, you are deluded. It's not going to happen. So this is something we have to be protecting ourselves against, and emotionally being able to deal with it as well. Having your systems in place to go, yeah, this is going to happen. But what's worse, getting knocked out when it kind of pops and drops with a full stop loss, or when it pops and drops trying to get out break even? What would you rather do? I know what I'd rather do. And emotionally, it's easier for me as well. So when I'm free rolling the trade, emotionally then when I have 2/3 of the position or half of the position back, emotionally, psychologically, it's easier for me to then try and sit for the home run trades, sit for the big trades, assuming the market I think is right and the monthly 10 EMA, the NASDAQ composite is above its monthly 10 EMA, as I've explained the importance of that in recent videos, like the blueprint video that you can find on the channel where I outline my trading process. So is this irritating? Yeah, absolutely. Of course it's irritating, but it's going to happen. And if you think you can not be involved in trades that pop and drop like this, I think you're deluded. Unless you're maybe going to take one trade in your trading career and that just happens to be a big winner. But then you're only going to take one trade. What's the point? Example, position, okay, 3,000 shares. So our initial risk on the trade, okay, is $19,890. Why? Because we have $6.63 risk per share times by our 3,000 shares. So that's that minus $6.63, which is 4.15% relative to the ADR. It's about the same as the ADR. It's a shakeout demand tail following another shakeout demand tail and holding the 50-day moving average. That's where I'd rather look for commodity stocks around, say, that 50-day and bigger bases like the stock was building. So by selling 1/3 of the position, okay, at a $4.46 gain times by 1,000 shares, we're locking in $4,460. We still have our 2,000 shares, but we have a loss on those 2,000 shares because of the pop and drop nature, and I pushed the stop loss up. I didn't leave it down here. I pushed the stop loss up. This is a common thing that I do in the trading. When it starts getting out, I'll free roll it, push stop losses up. Okay, loss on 2/3 of the position, $5,400. So $2.70 times by 2,000 shares. So we now have a net loss on the trade of $940 versus nearly 20 grand. Make sense? It's a 20th, it's a 20th the loss. Had you have just left your stop loss down here and had the pop drop, 20th the size of the loss. What trade did you want to be? Decide for yourself. This one here, and then this will be the last one. Then I'll take you through a bar by bar example with Meta, previously Facebook, on TradingView, and show you how to kind of think about this. Okay, so this is MDB. Here's one that I traded here, puts in this inside bar on the 10-day EMA, volume dries up nicely, gap down reverse bar here, good reaction to the earnings, starts building basically a Davis box type base. So this one here, again, higher price stock, okay? So entry plus free roll 1/3 on the breakout day, and I push the stop loss from low of the shakeout demand tail day to low of the now breakout day that also has a 52-week high on the breakout day. That's really good. I don't want to see a stock like this fail. Like, it should be getting out here. It shouldn't be undercutting the low there, especially with a 52-week high, but turns around and drops here. Okay, so what I do here, the initial risk in this 3,000 share example is $47,670. We want to get that risk out, okay? So why? Because we have $15.89 risk per share, which is a 4.06% stop loss, so same as the ADR pretty much. But here, it's a much higher price stock, so the dollar risk is going to be greater. So $15.89, but the percentage risk is still relatively tight versus the ADR percentage. Underneath the ADR percentage, well, it's around the ADR percentage, underneath 5% in a leading stock. Big AI component to it as well. So the profit on selling 1/3 of the position at a $15.57 gain times by 1,000 shares is $15,570. We still have 2/3 of the position, so we still have 2,000 shares. Now the loss on the 2/3 of the position is actually 20 grand in this example. So it's a $10 loss on 2,000 shares. And you can see here, exit at 38179. So I'd pushed my stop loss up here, but I got knocked out because it gapped down. So it actually gapped down to the 21-day EMA. So I get knocked out here. So where I'd expected to get knocked out, if I do get knocked out, okay, I didn't get knocked out there. It's a gap down reversal bar. So I had slippage. I had the gap down. So I didn't exit where I intended to exit. So I actually come out the other side of the trade in this example here with $4,500 loss. Happens, right? So I'm not just showing you the sexy ones like NVIDIA at the start. I'm showing you the ones where, okay, got out better than break even because of the active risk mitigation. I'm showing you ones where slippage with those shakeout demand tails. On likes of Shockwave Medical, I'm showing you ones here like on MDB, gap down reversal bars, where I then had a bigger loss than I intended on the remaining part of the position. Because guess what? It's trading. You're not trading from a book. You're not trading from a textbook. This happens. Like, it happens. So what I'm going to do now is I'm going to take you across to TradingView. We're going to load up Meta and I'll take you through bar by bar an example and really kind of explain this process to you. Okay, we're on TradingView and we've got Meta loaded up. So this is where I was looking at Meta here, okay? So obviously, mega cap stock showing a lot of relative strength. This is a free tool on TradingView. Search my name, you'll find it, Jack Corsellis RS line. It's hitting 52-week highs, which are these blue dots, while the stock is still within the base. Really, really good sign. When you take a look around the base lows, there's a gap down reversal bar here, a shakeout demand tail here, a big shakeout demand tail here. What do you think large operators are doing around the lows of a potential base? Looks like they're accumulating, shaking out weak hands. Two things large operators require above everything else: liquidity and perceived value. Shaking out the weak hands, and look at the relative strength line turning up. The S&P is basically doing this, while Meta is just going, no, 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 no. I'm basically going to hang on in there, try and make higher highs and higher lows. And then you start to see it clustering, or price tightening around a clustering of three key moving averages, being the black line being the 10-day EMA, the blue line being the 21-day EMA, and the purple line being the 50-day simple period moving average. I really like it when price gets really tight around those, and then you see those optimal candlesticks I was telling you about earlier. So there's a gap down reversal bar. There's a shakeout demand tail. Look how the volume is below the 30-bar average. There's a 52-week high on the gap down reversal bar, and the stock is still well within its base. Meta is telling you it's extremely, extremely strong right now. Extremely strong. So, how do we plan out the trade? Well, we can take a look at the 20-day ADR percentage, which is 2.71%. I use this one here. Okay, ADR percentage by AMR Trade, I think that's how you pronounce it. I use that one there. I then also use the fib retracement tool. So if you want to find the fib retracement tool, it's here. I put it in the favorite, so it's nice and easy. Now I grab this here, I will hold control. So I'm holding control and I'm snapping to the high of the bar and snapping to the low of the bar like that. I will then double click on it and I will just set it a cent below the low of that bar. Okay, so 29947, that's where my intended stop loss is going. If you want to see how I set it up, the fib retracement tool, 0 is going to be the stop loss level, 1 is going to be the entry price, so in this instance here, 306.21, and then the purple line set at 2, that's going to be 1 times the initial stop loss, and the green at 3, that's 2 times the initial stop loss. So my free roll targets here, if I now enlarge Meta like this, okay, let's just zoom right into it like this, okay? So when I'm now looking at Meta like this, my targeted entry is here. So what I would do is I will do a buy stop limit order at 306.21. Now I will attach the limit within 0.5% of the high of that bar. I'm not going to do that just so I can keep it a little bit simple. Then what I will do is I will have my free roll targets. So for me to free roll, I could sell half at 312.93 like this to free roll, or I could sell 1/3 here, and I would use a sell limit order to do this. I could sell 1/3 of the position at 319.64. Here's how I'm planning the trade out. Now I will zoom back and I will look at, okay, if I'm buying lower in the base, I'm looking at, okay, where's local highs in the base? So this is probable areas where the stock may stall out. I'm looking here, I'm looking up here as well. Base highs, local highs, if I'm buying it lower in the base, I'm thinking about, okay, price could pop into that level. That's where it could stall. Overhead supply, psychological resistance level as well. Traders like me are looking at that and potentially selling into it. Supply overpowers demand at that level, becomes a self-fulfilling prophecy quite quickly, and the share price comes down. So this is how I'm planning the trade out. So again, we're working through. Now, this is one that I was targeting on this day. If you remember the platform, go and look at the weekday video from, it would have been for Friday the 6th of October. You can go and see me doing this ahead of the market opening, okay? So I'm not just picking this one out, showing you a stock that I was targeting. And you can go see the reasons why in that weekday video from the, again, it would be Friday the 6th of October if you want to go and take a look at it. So this here, okay, I'm planning the trade out and going, okay, where am I free rolling? How am I thinking about this one? How am I controlling the risk? Where am I looking to free roll? So we're planning the trade out. We're identifying it. We're controlling it. We're thinking about the risk mitigation. So here, the intended stop loss, assuming really good execution. Now, really good execution is going to be more likely on Meta than it is, say, a small cap biotech stock that's very volatile and doesn't trade very much because of the liquidity of Meta. So the execution is likely to be much better on a Meta. So what I'd then be doing here is thinking, okay, assuming we get perfect execution, again, just for the purpose of this, I'm going to assume really good execution. My initial stop loss is 2.19% relative to the 20-day ADR percentage of 2.71%. Now, why is the ADR percentage important for me? Well, number one, I could use it as a risk metric to see, am I keeping the risk in check? Ideally, I'd like it half to 2/3 of the ADR percentage. It's just over 2/3, isn't it? So, okay, that's okay. But it also then helps me with the risk mitigation. So we're working through the process. Number one, we've got to identify a high quality setup. Number two, we've got to control the risk. Number three, we've got to mitigate the risk. Then we'll start thinking about optimizing profits. But with the risk mitigation here, I can think about what is probable for Meta. Is it probable or likely that Meta is going to go up 10% in a day? 4 times its ADR percentage? Probably not. Is it probable that it could go up 3%, 2.71%? Yeah, that's how much it's moved in the last 20 days. So then when I'm thinking about the risk mitigation, I'm looking here to here and I'm going, well, for Meta to get out, so to go up $6.72 from my entry, okay, here if I go to 6.72 like that, it's got to go up 2.2%. So look, my risk, my intended risk, assuming perfect execution, is $6.72. For me to free roll the trade, so sell half of the shares at 1 times my initial stop loss, and maybe I can move it up. We'll talk about that in a minute when we start going bar by bar. But a $6.72 gain is going to be a 2.2% move to the upside. Can it do that? Is that reasonable to expect? I think so, because the stock on average over the last 20 days has moved 2.71%. So it's reasonable to expect it could go up that much. Therefore, I could free roll on day one and get the risk out of the trade. Nice, right? So let's play it forward, right? And let's imagine that I'm now going to go, okay, Meta, it's choppy, it's hostile. I can see this local high here. I'm going to try and free roll into that. So let's just play it forward 1 bar, okay? And there we go. We've been able to free roll on day one. Gets out really well. Now we can have another option here as well. So watch, as the stock starts to get out, let's say you went, I don't know if I want to sell half. Okay, so let's remove that and say you were looking for a third because you were like, okay, highs of the base up here. So let's say you were thinking, okay, highs of the base up there. I'm going to try and free roll underneath that level, underneath like 322.50 or something. So you had a sell limit order in for 1/3 of the position at 319.64 up here, okay? And we're assuming perfect execution here, okay? Where you bought it. So you went, nah, I'm not going to sell a half. I'm going to sell 1/3 at 2 times. Okay, so if we were doing that 3,000 share example, we're looking to sell 1,000 shares up here. Okay, but what we could do now, you now have new information available to you. So this is a Bayesian mentality, a Bayesian mindset. What does that mean? It's a fancy way of saying you update your decision-making process as new information becomes available. You update your decision-making process when new information becomes available. So, well, we now have the stock that's out. It's got out around about 3%. Remember what I was saying? Think about it relative to the ADR. 3% was reasonable. It's reasonable to expect Meta could go up 3%. But we still have our stop loss down here at 299.49. Is that now an optimal place for our stop loss? Why do we need our stop loss there? Why could we not move our stop loss up to lower the breakout day? Why would we need to see price come all the way back down here like this? Why do we need to see that? Do we? Do we not? It's a question, right? So what if now we could go, well, why don't we just move our stop loss up to lower the breakout day? That's then going to bring down our free roll target. So watch this, ready? I'm going to grab here. I'm going to snap it to the low of the bar. And what I'm going to do is 1 cent below. So our initial risk on the trade was down here. I'll keep the level in if you want, if that helps you. Okay, at 299.49. So our initial risk was down here at 299.49, which was $6.72 risk per share, $6.72. of risk per share, 2.19%, again, assuming perfect execution, which is rare, but for this example, to illustrate the point, that's what we're going with. But now what we've done is we've just moved our stop loss up. So look how these free roll targets have come down. Okay, our free roll target is now, not here, at 319.64, which we'll just put in green up here. Our free roll target now is here for 1/3 of the position at 316.82. That's interesting, isn't it? So what's our risk on the trade now? So again, just by moving that stop loss up like that, if I just go from here to here, and let's just put these levels in, 306.21, and then to the low, 300.90. So our initial risk was 2.19%, but if at the close we were to move our stop loss up to the low of the breakout day, well, we've now started to mitigate risk. You don't have to mitigate risk in one fell swoop and go, yeah, right, break even on the trade. You can stair step into it if you want. So here, if we just went, right, what I'm going to do is move my stop loss from 299.49, and I'm going to move it to the low of the breakout day like this, to $390, just underneath the low of this day. This is a really good breakout day. Look at the 52-week high as well. Meta is very, very strong here. We've started to mitigate risk. You've now taken it down from $6.72 of risk per share down to $5.31. So from 2.19% to 1.73%. Well done. You have an option here to still sell half of the position. You could maybe sell 1/3 of the position. If I was, watch this, ready? If I now pull this stop loss up, what I'm going to do is I'm going to drag down this 1/3 target to the high here. Okay, so price closed at 315.43. 315.43, remember that level. So what I can do here is I could just start to move the stop loss up. And what I'm looking for is for when price gets to, sorry if the clicking is irritating you, 315.43. Okay, let me just do it. Let's just go to kind of like 10. What does that get? I'll drag it up because the clicking is probably irritating you. Round about here, okay? At the close. There you go, it's pretty close. So what we could now do here is go, well, do you know what? Do you know what? Actually, what I'm going to do, let me just remove this line here. Let's push that sideways. I want to get rid of this line like that, and then we'll drag this one back over. What we could now do, again, scenarios, options, risk mitigation. What do you want to do? What you could do here is you could go, well, at the close here, I've got a gain of about 3%. Okay, 3%. What I could do is move my stop loss up from 219% to 1.5%, which would be about 301.61. And then I could sell 1/3 of the position here. And now I'm effectively break even on the trade, because if the share price comes all the way back down here to 301.61, I probably don't want to own it. So what we could do here is we could now go, right, what we're going to do is we're just going to sell the position here, like this. Sell 1/3 at 315.41 like that. Not 3,000, 315.41 like that. So then at the close here, we've now free rolled the trade. And our stop loss is now placed here at 301.61. Do you see the different scenarios that we can create there? We could just stay with our initial stop loss, but we still have all that open risk. Yeah, we've still got our entire position, and there's a decent profit in a day for Meta, but we've still got all that open risk. Or we could be now, heading into the next session, we're like, okay, nailed a third, feeling good about the trade. A lot of trading is psychological and mental as well. Feeling good about the trade, sold 1/3 of the position, nice, free rolled the trade, feeling good about it, chilled out about the position. Stop loss is now down here at 301.61, because if the share price comes down to 301.61, you'd imagine there's a very, very, very high probability it's going to go to 299.49 and you would have got stopped out here. So if it comes down to this level, you would have thought there's a very high probability it goes through that level where your initial stop loss is. But now heading into the next session, you have got 2/3 of your position and you're effectively risk-free. Hypothetically risk-free. You know, gap down, slippages, as I've been showing you. Which trade did you want to be? Which scenario do you want to be? Now, we won't talk about optimizing profits and stuff like that in this video, as it's over 50 minutes long already. But does that make sense? For how you can think about the third part of the trade, the part no one will teach you about. Now, yeah, is it great when trades like this happen? Yeah, of course it's great when trades like this happen, but they don't always happen, as I've been trying to show you in this video. You will have fake out breakouts. You will have pop and drops. You will have where the stock kind of gets out and then comes back down like this. And rather than coming out the other side with a full stop, I'd rather be as close to break even or backstopping in a profit as possible when I think it is prudent to do so. And I will adapt that. I will change and tweak the system somewhat given different market environments. If I think we're in a healthy market environment for my style of trading, which is active swing trading, but I'm also an intermediate term trend follower. I am active early on in the trade and then I try and sit out and let the trend play out. Okay? Or is it a choppy market? Or is it a hostile market? How are you tweaking your systems? What are the inputs you're putting in? Your trading and your strategy has systems, it has input. You are responsible for them. What are you doing? Take ownership, take control of it. I think it's really important. So that is it, guys. I'll wrap the video up there. I really do hope that video was useful for you in terms of thinking about your trading, thinking about it from number 1, identify a high quality setup. Number 2, control the risk. Number 3, mitigate the risk. Number 4, optimize profits. So if you made it all the way to this video, I would really appreciate it if you could like the video if you found value and enjoyed this video. If you could subscribe to the channel as well if you haven't already done so, that would be absolutely fantastic. I really do appreciate all of the support. And as always, I look forward to seeing you in a future video.